Well, I think there's clearly sort of the contours of a deal. You get a sense as an investor of where things are heading. And that is, they want to make trade deals with most of the countries in the world. It feels like it'll be around 10%. The countries will eliminate non-tariff barriers. There'll probably be some exceptions, so the effective rate will be below 10%. And I would guess the UK, India, Japan, Korea, one of those countries will strike a deal here fairly soon, and it'll give investors confidence. So I think that can definitely happen. And what investors are looking for is terra firma. What's the path of the world going to look like? And that's what they're focused on. I think the one part that's more challenging is the China situation. Obviously, the size of the tariffs, the number of issues, that's more complicated. That feels like it'll take longer. And to me, the key is getting this sort of sense of certainty faster, because then investors and companies can start to move. The longer this goes on, the more risk of an economic slowdown.
I'm glad you mentioned China, because to the extent that the tensions remain prolonged, how does that impact activity for U.S. investors that may have supply chains linked to China or investments in China?
Yeah. Well, we fortunately have a small number of companies directly impacted, but for those companies, it is pretty meaningful. And so those companies are thinking about their cost structures. They're thinking about, can they move their operations, where they supply things? Oftentimes that's difficult. Can they pass on costs to consumers? Can they pass on costs? You know, can their suppliers absorb some of this? So there's a lot working around this. 145% is pretty tough, though. And so my expectation is there'll be something happening over time. But as I said, that's tougher. I do believe the administration can do something around the rest of the world. And as I said, I expect that to happen beginning over the next few weeks, but then playing out over time.
So a lot of people are looking at the soft data, the hard data, having a hard time parsing through it. I'm going to do something different. I'm going to look at the Blackstone barometer for a moment here. You have a lot of data across your portfolios. What's happening in terms of inflation or an economic slowdown? Where are some of the signals that you're keeping an eye on?
So I would start on the economic side, and I'd say it is difficult to have real data because it's only been a month, and there were actions people took to accelerate purchasing. So there's a lot of noise. So I think you've got to focus more on the anecdotal. There, what I'd say is, in the companies directly affected, the retailers, manufacturers, they're moving to look at their cost structures. There's real pressure there. And so I think we are going to see some slowdown and a real impact on earnings. In the rest of the economy, what I'd say is there's more just a sort of a blanket of caution. You know, big things like leases and capital expenditures, we've seen a slowdown in those areas, just as CEOs say, hey, I want to wait and see what's happening. But there's still pretty strong employment, so I think a lot of the numbers will be good. As I said, it's really a question how long this lasts. On the inflation side, that's where the data so far has been pretty darn good. There's a lot of discussion of sticky inflation. And yet in our companies, 230 companies, 13,000 pieces of real estate, we see shelter costs in the US much lower than the government data. Obviously, energy costs have come down. But interestingly, the labor market's been softening. We survey every quarter our companies. And if you went back 3 years ago, 93% of our CEOs said it's hard to hire people. In the first quarter, before all the tariff diplomacy set off, it was down to 30-ish%. And so there's softening there. So I think the Fed's going to get a lot of very good, non-goods related inflation data. But then on the good side, we're obviously going to see something different on the tariff. So overall, I think the inflation picture is strong. But obviously, this tariff dynamic creates a different potential outcome.
How hard do you think the slowdown is going to be for the employment market? Do you think that jobs are really going to start to fall off a cliff here amid this uncertainty?
No, I think there's more resilience in the economy. I mean, if we went back 3 years and said the Fed's going to raise rates 550 basis points, we would have been very concerned. The economy's going to slow dramatically. It held in there. In the first quarter, if you looked at our companies and private equity, revenue growth was 6%. So we went into this with a lot of momentum. I do think it causes a slowing in GDP growth, causes a slowing in employment. But again, I tie back to the duration of this. If a lot of this can get resolved more quickly, then the slowdown can be much shallower. The longer it goes on, the more risk. I think the administration recognizes that. That's why I think they would like to make some transactions more quickly. And obviously, the countries on the other side would like to see these tariffs get down to a lower, more manageable level. So I think I'm in the camp that there'll be a slowing, certainly, but nothing like you're describing, sort of a falling off a cliff.
Now, what do you make of the desire to deploy? We have seen asset prices correct quite meaningfully this year. Is it enough, though, to spend large dollars right now?
Well, I would say as investors, we have $177 billion of dry powder, and there's always opportunity somewhere. So today, if I said what are the most interesting areas, the secondary space where we have a lot of limited partners, many here, who are thinking about, well, maybe there won't be as many IPOs and as much M&A. Maybe I should just sell my interest in the funds. We have the biggest business in that space. We see a lot of opportunity in energy and power. I think one of the things that's lost in the tariff news is this incredible technology revolution that's happening. That's the main thing. This will get resolved, my guess is, over the 6-9 months coming up here. But what's happening with AI, what's happening in terms of productivity and margins, that's going to be pretty powerful. And there's going to need huge electrification installed across the economy. So investing in that space is very interesting. I would say the recovery in commercial real estate continues to be a story for us, with new supply down dramatically. And we think it's a good time to enter this. And then globally, Japan, which is really restructuring its economy, becoming more open to investing. India, where we're long-term bulls and have been the biggest foreign investor in private equity and real estate. So we think there's opportunity. And as you know, people are very enthusiastic in 2000, 2007, 2021, when actually risk is the highest. And it's in moments like this where there's more uncertainty, more caution, sometimes it's a little harder to get financing. That's when you try to step in and take advantage of opportunities.
So you mentioned a few places around the world. It's important at a time where a lot of investors are asking about the risks to U.S. brand, the risks to the U.S. exceptionalism story. How do you see this playing out, and are you putting your own dollars across the world more than you are here at this moment?
I wouldn't say we're shifting our mix. It's really opportunity driven, or the funds, their mandate driven. I think there's been often calls for sort of the end of U.S. exceptionalism. I think over the last 15, 20 years, around the global financial crisis, the debt crisis, certainly in COVID, I think the U.S. has some powerful advantages: the liquidity of our capital markets, the rule of law, and then the strength of the innovation in our companies. And I think as we continue to lead in that way, that's what makes the U.S. exceptional. Obviously, the last month put a little bit of a challenge, and clearly here in some of the meetings, particularly from investors overseas, there are questions. Am I too exposed to the dollar? Should I be concerned? We would say we think that this will settle. The Madisonian system works. The U.S. will continue to get through this, even if we have an economic slowdown. Now, that being said, the dollar had rallied a ton. So putting everything aside, is it illogical that it came down 10% over the last month or so? No. So I think you can continue to have a lot of confidence in the U.S., but at the same time, there are opportunities in other parts of the world. That's why we're a global investment firm. And for investors, having some diversification, I think, is very important.
Jon, you mentioned secondaries being a big opportunity right now. What is it that you're seeing? Why are limited partners looking to offload stakes right now? Is it because of the performance of the underlying managers or their own liquidity concerns?
I would say it's mostly about liquidity. If you think about most of our investors, the big pension funds, they tend to have targets. I'm going to be 13% private equity and 10% real estate and so much private credit and infrastructure. And because we haven't seen the velocity of sales, of IPOs and M&A activities, you've seen those numbers creep up. they want to make new commitments to new managers or existing managers. They have relationships. They want to free up capacity, and they just haven't seen the liquidity. So they have this other exit option, which is through the secondaries market. And that is why you're seeing the velocity. In some cases, the U.S. endowments are facing more pressure because of some of the things happening with the administration, potential taxes, less funding. I think they're looking for liquidity. But generally, I would say it's mostly because investors are at or near targets institutionally, very different than insurance companies or individual investors, and they're looking for that incremental liquidity.
Final question for you. I'm going to do what you hate. I'm going to make you choose your favorite child within Blackstone. What is the best investing opportunity right now, given the environment we're in?
Oh, that is so hard. Look, I would say we continue to believe in this electrification trend, which I talked about earlier, and that space is very exciting. And then I would add, what's happening in life sciences is incredibly compelling, tied to the technology again. So I could give you 10 more, but I'm going to stick with 2.